So maybe you've been thinking about passively investing in someone else's real estate project, right? You don't necessarily want to be the person responsible for doing all the work on the ground, but you do want to diversify your portfolio. So you thought about doing passive, right? You can still get a lot of the benefits of real estate investing, like cash flow, like tax benefits, appreciation upside, but without actually doing all the physical work, like dealing with contractors, brokers, lenders, tenants, and everything else in between. So if you've been thinking about passively investing, it's a great avenue, and there's certainly a lot of upside, and I've done videos on that on my channel. But what you need to be aware of is also how to evaluate the risk factors with a passive investment, right? Because even though you're not necessarily the one being actively doing everything on the ground, there are certain risks that you need to mitigate for and that you need to be comfortable with in order to make that strategic, right, passive investment. So in this video, I'm gonna give you guys my 3 major key risk factors you need to evaluate if you're thinking about doing a passive investment. And make sure you stay tuned for number 3 because that's probably the most important one. So with that, let's get at it. What's going on, guys? My name's Lior and welcome back to my channel. Now, before I get into the content, 2 super quick things. Number 1, if this is your first time on my channel, make sure you smash that subscribe button to my channel. I put out tons of new videos every single week talking all about rental property investing. I give you guys case studies on BRRRR deals that I've done, give you guys nightmare stories from tenants, tips on passive investing, tips on personal finance as it relates to real estate investing, and everything in between. So if that's the kind of content you guys are looking for, make sure you smash that subscribe button. And number 2, if you guys have been thinking about doing a BRRRR deal, a buy, renovate, rent, refinance, repeat, try saying that 5 times fast. If you've been thinking about doing that or investing in a BRRRR deal, make sure you check out my free downloadable PDF example of a recent deal I did. It'll give you guys some more context, some more details about structure, financing, returns, and that much more. So make sure to check that out. So with that, let's get right into it. So before I give you guys those 3 key risk factors that you need to evaluate as a passive investor, let's actually kind of flush out a little bit more about what it means to be a passive investor, right? I touched about it in the beginning of the video, but a lot of people that maybe are invested in things like stocks, bonds, mutual funds, Bitcoin, whatever it is, right? A lot of investors want more diversification within their portfolio, right? And a lot of people understand the benefits of real estate, right? They know they could get cash flow, they know they have appreciation, they know they have equity pay down, they know there's numerous tax benefits. But look, real estate is anything but passive, right? I mean, if you're the one buying a property, you know that you need to be in touch with lenders, brokers, contractors, property management companies, vendors, right? I mean, it really is a full business. So for a lot of you guys that are just looking to diversify into real estate, passive investing makes sense, right? And basically what you do is you could go find what I called an operator, right? So someone that's on the ground actually executing on deals, and you can actually be the fund provider, right? So basically what will happen is the operator, right, will be on the ground, and he's the one that's kind of in touch with everyone I just talked about, right? The contractors, the lenders, the brokers, and he kind of runs the day-to-day operations. And then you can passively invest and be and essentially provide the funds for each specific project, right? And then you can incur in the benefits that we talked about. So that being said, right, I mean, it's obviously a great model. There's great benefit for you. There's great benefit for the operator. It can be a fantastic win-win situation. But before you actually invest your funds, you want to make sure you evaluate 3 key risk criteria. And we're going to start with the first key risk criteria, which is really understanding your market and asset class. Now, the reason why this is the first one is if you've ever read a book on real estate investing, probably one of the most common tips of advice at first is before even looking at properties or anything property specific, you got to be super comfortable with your market and asset class, right? Because even if you're going to be passively investing, you're still going to be part owner in real estate, right? And if you're going to be a part owner in real estate, that means not only are you investing into the property, but you're investing into the market. So I always encourage anyone, whether it's passive or active investing, to really do their due diligence on the market, right? Make sure it's a good market that you like, right? Make sure it's growing. There's a lot of economic activity. There's population growth. You see that there's some sort of trends for further continued future growth. Whether that means some sort of people are moving here, whether that means companies are moving here. But you want to be super comfortable and make sure that you're investing into a strong market. You also want to be making sure that you're comfortable with the asset class that you're investing to, right? Because even if you're going to be a passive investor, you can invest into assets like multifamily, assets like industrial, commercial, and many other types of real estate. And even within each of these classes, you should dig even further, right? So if you're going to do multifamily, are you going to be doing Class A luxury product? Or are you going to be doing Class C or B value add product, right? So there's different sorts of segments within each of these categories, and you really want to nail down and, hey, what am I the most high on? What do I want to be invested in for the next couple of years or long term, whatever it is? Where do I see the most potential and what do I feel the most comfortable with? So once you do your due diligence on that and you kind of are settled on an asset class and a market, right, now you can go more deal specific. And my tip, risk factor number 2 that you need to evaluate is really understanding the proposed business plan and strategy of the investment you're going into, right? And here's what I mean by that, right? So let's say, again, you're going to be passively investing and you get a couple of offering memorandums from some operators, right? Where they pitch you a couple of deals that they're currently doing and give you the opportunity to invest in them. So each deal that you're considering investing, one of the big things I encourage you to do is really evaluate the business plan and the numbers behind them, right? So, in terms of business plan, you could be investing into something that might be turnkey and all the operator has to do is buy the property and then just manage it. Maybe it's a heavy value add though, right? Maybe there's a large construction component to it and the plan is to go in, renovate a bunch, bump up the rents, and do it that way, right? But whichever scenario it is, you want to make sure the financials align with that, right? So if it's a construction project, you want to see, well, how is the operator going to be financing the construction, right? Are we getting a construction loan from the lenders, or is he trying to raise money for construction? If it's the other side, if it's a turnkey property and you see a line item for, hey, I want to raise money for construction, that should also kind of be a little bit of a red flag, right? So you want to make sure the financials and the raise kind of align in terms of business strategy. The other thing you want to do too is really double check the numbers, right? And this is why I said really understand your asset, your market and asset class, because you're going to want to get some sort of base sense for numbers in that particular market. So for example, if the plan is going to be to buy a value add deal where you're going to be doing renovations and then increase the rents, you want to have some sense of rents in that area, right? Because, if you see on the memorandum, like, hey, my plan is to charge $3,000 for 2 bedrooms once I finish the renovation, and you know that, hey, I've only really seen 2 beds go for like $2,000 or $2,100. Again, like, you want to start kind of gut checking these numbers and making sure they're reasonable, right? Because at the end of the day, this is going to be part of your investment. So making sure that proposed rents seem reasonable, making sure proposed cap rates seem reasonable, proposed expenses seem somewhat reasonable. You don't need to be a total expert, but you want to give this a gut check and make sure that the numbers somewhat make sense and are relatively reasonable from all the research that you've done. And finally, risk factor number 3, and I think is probably the most important. I know I've talked about this in other videos, is really understanding the operator. And here's what I mean, right? If you're going to be passively investing, the person that's on the ground and actually executing on the deal is probably going to be one of the biggest factors in determining the success of your investment, right? There's actually a famous saying that, like, a crappy operator can completely destroy a home run deal in Beverly Hills, California, right? And basically the point of this is a bad operator can take a home run deal and completely ruin it, right? So you really want to understand who you're investing with, right? So I would do due diligence on the operator, including trying to understand his track record, seeing what kind of projects he's done in the past, what kind of returns he's delivered in the past. See if you can, maybe Google his name, see what kind of reputation he or she has in the market. But I would try to get a really, really good feel of the operator, right? See what kind of content he's put out in terms of videos, blogs, website, and everything in between, right? Because again, I think the skill and the experience of the operator is probably going to be one of the biggest factors that drives returns. If you get stuck with a bad operator that isn't necessarily going to be able to perform, your passive investment is certainly going to be in jeopardy. So definitely do as much due diligence about the operator. I think that's going to be absolutely crucial. So those are the 3 factors I would really do a lot of due diligence on, and I think that pose the most amount of risk for any passive investor. Make sure you guys really hammer those out. And if you guys have any questions about how to do that, what you should be looking for, how to evaluate it, just throw it in the comments below, and I will definitely help you out.